We'll get started and have some fun. For those who don't know, the word of the day is secular. Secular in the context of a secular bull market or bear market, for that matter. I don't know if you were biased. You'll have to decide that, Doug, when we ask you a bunch of questions. But secular is the word. Okay, so I'm Dan Weiskopf, ETF professor, also lead ETF strategist for the ETF Think Tank. Welcome to the happy hour this Thursday. We're very fortunate to have Doug Sandler here to answer seriously all our questions and make for a very interesting dialogue. So with that, I'm just going to hand over the mic to David to introduce himself. And thank you.
How's it going, everyone? David Chikansky here. Manage the SoFi Gig Economy ETF as well as the Amplify Inflation Fighters ETF alongside our fellow PM Mike Vignoto, who could not join us today, but we have a very good show. Lots of asset allocation discussions, hopefully some tidbits that you guys can take away for your own use. And I will kick it off to Cynthia.
Hi, everybody. Cynthia Murphy, head of research for the ETF Think Tank. As always, I'm super excited. Thursdays are my favorite day. I'd love to pass it to Doug. Doug, please introduce yourself. Tell us a little bit about what you do, what keeps you busy day to day, and we'll kick things off.
Yeah, sure. Thanks for having me. Doug Sandler, currently work at Riverfront Investment Group. It's a relatively small money manager. We manage just over $8.5 billion. We've been around since 2008. Prior to that, this is my 30th year in the business, by the way. Prior to that, I worked for one of the larger broker dealers as their chief equity strategist.
Yeah, so Doug, I'll start with just a random question about Riverfront. You guys have as a team have been together for a long time. Give us a little background around that, and then we'll start throwing some questions about secular trends in the markets.
Yeah, sure. Riverfront, the core sort of starting group, was there since we worked as a team, really going back to the late 1990s. As a combined team, 2002 is sort of when our track record started, where we were actually managing money as a team. Back then, we managed portfolios that combined ETFs and individual stocks and individual bonds. Today, our portfolios look a lot more like 90% ETFs or 80% ETFs, with the balance being in individual stocks. And the reason for the change was way back in 2002, 2003, there just weren't a lot of ETFs. So if you wanted to get granular, not just own the S&P or just, have a bet in a sector, you really had to go outside of the ETF universe to do that. Just an example is AG, which is the, most probably popular bond ETF out there. It represents the Bloomberg aggregate index. That didn't come out till 2003. So if you wanted to invest in bonds and you're an ETF investor, your choice was really just treasury ETFs. If you wanted corporates or mortgages, high yield or any of that, you would have had to do that through some other product like an individual bond or a closed-end fund. So our team's been together since then. I kind of think of money management like a team sport. It's a little bit like, football, hockey, baseball, whatever, which is, you want to have, certainly want to have really talented, superstars on the team, but it's a little bit more about how the team works together. Right. I always use the analogy of the Olympic basketball team. I forgot what year it was. It was 2004, where, a bunch of superstars that never got to the medal round. And, it's more about the team playing together, understanding each other's strengths and weaknesses, and then, working together. And that's what we've done. So we may not have, the superstar that you hear about every day in the newspaper, and we kind of like it that way.
So I'll throw the first softball question to you, Doug. What are your thoughts on the U.S. equity market and the secular trends? Sorry, that we're seeing.
Did you say secular? All right. Yeah. So if we go, so I'd say there's two ways to look at it. The first would be the long-term way, and maybe I'll touch on that first. And then there's the, immediate, next 6 to 12 months. In the long term, which we call secular, right? If you heard that was secular, right? So you got to do that again. Secular is another way to say long term. And we are in a secular bull market. How do you like that? And I've had to drink 5 times.
We're not going to make it to the end at this pace.
And they're back in history, going back, 100 years. There's been basically 4 secular bull markets. We're in one of them right now. And our secular bull market started in 2009. But if I look at the other 3, they all share similar characteristics. There was one in 1921 to 29, one in 1942 to 66, and then one in 1982 to 2000. And the 3 characteristics they all shared was, number one, they all lasted a long time. If you did the math, that's an average of 17 years. Not a huge sample size, but 17 years is a long time. The second characteristic was that they were very remunerative, meaning that you made a whole lot of money in the secular bull market. The average was about 10 times off the bottom. Can any of you on the panel name the bottom on the S&P? This is going back to March of 09.
David, come on, man. You're the king of knowledge on that stuff.
And I could tell you on a percentage basis how much they were all down peak to troughs, but the actual number, I think we were at like literally 50.1 on peak to trough in S&P 500 in March 09th, but I don't know what the actual dollar number was or the print.
Oh, Eric Connolly is on top of a building there. Might be able to see it because there's red letters or red numbers in New York City where you can see 666 on one of the buildings. That was the bottom for the S&P 500, 666, a sign of the devil. Right. So if I do a 10 bagger off that, that's 6,600. Right. And if you don't regularly follow the S&P and watch the Dow, just to put in perspective, the S&P hit 4150 today. So if we're going to go like a normal secular bull market, right? Secular, if you do a normal secular bull market, 10 bagger is 6660. And, with upside from there. Now that could take a while, another 5 years. This particular bull market is 13 years. The average is 17. The third characteristic with a secular bull market is that they all end in bubbles, right? So number one, they all last a long time, on average 17 years. Number 2 is they're an average of a 10 bagger off the bottom. This one's gone up about 6.5 times. And then they all end in bubbles, and bubble valuations are probably 35 to 50% higher than we are right now. So if I'm a regular long-term investor, I'm 52 years old, all I care about is finding secular bulls and getting on the wave and staying on the wave and not getting scared off with every little ripple that comes, right? We normally, our clients are all retail investors, and that's the big thing that matters is you want to be in a secular bull and you want to be cautious in a secular bear. The last secular bear, by the way, was 2000 to about 2011 or something like that.
Doug, I'm making a new rule. You're allowed 3 secular drinks per statement. And after that, we're not drinking because no one is equipped with enough liquid for the rest of this.
I'll probably pick two, the word I'm going to use too often. So that's the long term. The short term would be that, we are in a cyclical bear. Cyclical is, somewhere 6 to 18 months. Maybe we're already through it. That's basically defined as, 20% off of the highs. We've already hit that and we've bounced back, almost, halfway back, probably a little bit more than that. I don't know if this is the bottom. That's the $1 million question. If I could answer that, have we bottomed? Is the inflation fears and recession fears behind us? I don't know. Currently, we're positioned cautiously. So we're not overweight stocks. We're actually a little underweight stocks. And the type of stocks we own are the types that do well in a more range bound or maybe even a market pullback. That's the incorrect positioning over the last 30 days. And we feel that. But we haven't been making a big bet, but we are defensive right now.
So what keeps me up at night is really expectations for earnings next year. Like, yes, we've been in this cycle where like earnings creep up and we just start rationing down our expectations in the last 30 days and no one really cares. And then we beat, and then it's like, hooray. But I question whether inflation goes down or not, just with geopolitical risks and everything. Like, how are we really on pace for record earnings next year when so much of that I would imagine is dependent on very cheap service like labor, where those wages don't seem to be slowing down at all?
Yeah, I think so. The big one is probably going to be the increase in the pace of the economy. So while real GDP is negative, nominal GDP is pretty high, and earnings are that we look at are nominal earnings, meaning they include the impact of inflation. So earnings should be up in inflationary environments. So question is, can companies contain the rising costs? And the answer is they'll probably contain more than we think. I've always been, taught and learned the hard way, don't ever underestimate American corporations, American innovation, and they'll figure a way through it. Initially, they'll get caught short, right? Or they'll get caught unable to pass costs along, and then they'll figure out ways to do it. So I think right now they're talking about 243 next year on the S&P. Put that in perspective, that puts the S&P multiple at about 17 times. I always like to reverse those numbers. You divide 100 by 17 and you get an earnings yield of about 590. And then compare that to how you do anywhere else, and that's pretty darn good, given we have a 10-year at 270. By the way, at the beginning of the year, we were at 22 times, which means our earnings yield was around 430. So we're now at 590 versus 430. I would call the last 6 months as short-term pain for long-term gain.
What are your thoughts on, I guess, the outlook of the U.S. dollar, specifically on international equities in the interim, in the next couple months, 6 months, 12 months, 18 months? Obviously, the dollar has rallied. That's hurt international equities. We know all the reasons why. We know the natural gas shortages in Europe and the debt dysfunction worse than our own in the U.S. But what are your thoughts on that? And when is it what are you looking for in the future to unwind a trade like that?
Yeah, so we're bullish on the dollar. We've been short euro and yen, to different degrees over the last little while. And I should say we don't get everything right. In fact, this year we've got less than normal right. And those were two trades that actually worked for us. The dollar is a function of lots of different things. So higher relative rates in the U.S. that attracts money to the U.S. Better economic outlook that attracts money to the U.S. I think what's going on, if I just compare the US to Europe, for example, both of us have the same inflation problems, right? Their inflation is not significantly different than ours. Yet we have an economy that's going at 100 miles an hour. They have an economy that's going at 5 miles an hour. Both central banks have to apply the brakes. Which economy is going to end up better off? And the answer is probably the U.S. economy, right? Because there's a lot of distance between 0 and 100 miles an hour, and there's not a lot of distance between 0 and 5. So, like the prospects of the U.S., that trade's probably 3/4 of the way done. Our euro was parity, maybe 95. We touched parity already. A lot of that trade's already played out, but we still like the dollar more.
So Doug, I mean, maybe you don't, I'm not trying to get into politics because I don't care about politics, but a little bit about policies, U.S. policies, and how you're, looking through your scope in that context. How are policies affecting markets these days?
Yeah, I think. I guess the answer is there hasn't been significant change in policy, at least fiscal policy. Monetary policy, obviously, there's been a ton of change, right? So monetary policy for the last, 13 years, we've benefited from very loose monetary policy. That means you're keeping rates low, actually pegged at 0 for a long time, and, printing money and all the other things that were going on. That created a rising tide that lifted all boats. So I didn't really have to pick stocks. I could just throw my money at the stock market as a whole. preferably towards companies that do better in a bull market. So higher beta, you might hear sometimes people say, that use that sort of strategy when that happens, right? It's about just getting participation and not being too picky. When the Fed changes what they're doing and they're now more restrictive, I wouldn't say totally restrictive, but they're doing two things. They're raising interest rates. So they're now at 2.25 to 2.5, up from 0. That's significant, but at the end of the day, 2% rates are still pretty darn attractive. Fed funds has built in another 100 to 125 basis point increase. So the market's assuming rates are going to go to 3.25 to 350, 375. And the other thing the Fed's doing is they're doing something called quantitative tightening. So we know what quantitative easing means. That's one way of saying printing money. Quantitative tightening is one way of saying, destroying money. So running the printing press in reverse. So you no longer have a rising tide is a long way to say it. And when the tide's going out, the boats aren't going to all get lifted. I'm going to have to pick among the boats. So it is going to matter whether, this company does better than that company. And our work is going to be a lot more difficult. I'm going to have to look at, the way you looked at stocks 10 years ago. I want to look at cash flows. I want to look at earnings. I want to look at balance sheets. I want to look at the quality of management. I would say most of that stuff hasn't mattered, the last 12 or 13 years. And that's why you've seen many professional money managers wring their hands.
So if I can quick follow on that. So is this we always hear markets like this are great for stock pickers, and everybody on your team, I think we're talking before the show, comes from a stock picking background. So how do you apply that through investing through ETFs then, if it really goes back to specific stocks and having to be super careful on which stocks to own?
Yeah, great question, Cynthia. Thank you. To sort of two answers to that question. One is anytime you buy an ETF, you're buying a basket of stocks. And the way we've always looked at the ETF market is as an efficient way to express our views on the market. If there was a new product called, LTFs, and it was a better way to do it, I would buy LTFs. And so, there's nothing magical about ETFs, right? They're a cheap way to get the exposure I want. So, what we always do is, let's just take the S&P 500, for example. We're going to look at the 500 stocks. We're going to pick the 100 or so that we think are better than the other 400. And then we have systems that basically tell us, if we want that portfolio, here's the way you get that thumbprint. It won't be exact. It'll be pretty darn close. It's going to be this combination of whatever ETFs. Now, most of the time, we're not making decisions with cash. We're making decisions with an existing portfolio. So here's the 100 names we own expressed through these 13 ETFs. I now want to look like these 100 names where maybe 20 of them have changed. What adjustments do I need to make to the portfolio to get from here to there, right? So it's that kind of work. You got to do the work on the stocks first to come up with, what you want your bets on. And then the ETFs are just an efficient way to express them. What we're finding in our portfolios now is, if I look 10 years ago, even a couple of years ago, the ETFs we own tended to be broad, right? I'm going to own S&P. I'm going to own large cap growth. I'm going to own stuff like that. If I look at what we own now, they're a lot more granular. I don't want large cap growth. I don't even want tech. I want software and services within tech, right? In some cases, we'll even go out and buy the individual stock that we like if you can't make the bet through an ETF. So for example, we own a warehouse REIT company. There are no warehouse REIT ETFs. And if you buy, the broad REIT ETF, warehouses only represent a small percentage of it, or minority of it. So I got to buy that individual name if I want exposure to that space.
But that's interesting. So you guys don't do at all the stereotypical core satellite idea. So really broad and cheap in the center, and then just, more niche and narrow funds on the outskirts. You're actually just building an entire quilt of very laser focused exposures.
Yeah, and you may actually see that when you look at the portfolios, you might see it looks like that, because sometimes the easiest way to get into these 80 names is going to be through SPY or something like that. And then you're going to see the other way we get to those names are through these other ETFs. So nothing's like absolute. Like we do a little bit of, like, for example, we have an infrastructure ETF, or we have. Not because we like every single name in there, but because at the time there was an infrastructure bill going through Congress. We felt like it had a high chance of passing. It didn't, but that was a way, to get more cyclicality into the portfolio and exposure to policy.
Hey, Doug, not I want to be correct in my statement, because we don't talk product here in the happy hour, but you might talk to Naveen about some of their ETFs in the way of storage, because they have effectively a storage ETF, which I think is what you were saying you were looking for. So
Sort of a warehouse one, but yeah, I mean, it's self-storage, or yeah. I'd have to look at it, but yeah, that's a great.
Yeah. I don't want to be too specific, but it begins with an N. Now. So anyway, I do have a question from the chat, and it comes from Ray Scheimer. Your thoughts on investment implications regarding Europe and their potential upcoming energy crisis? It's actually very serious, actually. A second question, do you consider China investable at this point?
Yeah, I'll take the Europe one first. So one of the reasons that we're negative on Europe, we're underweight Europe. We're global. We run global portfolios. So, what's going on in the world matters. We're underweight Europe, and the main rationale there would be just slower growth, and an energy crisis certainly would contribute to that and add to the inflation issue. So they're going to have a central bank that's going to be forced to be aggressive at the same time that their economy is struggling. So that's the definition of stagflation. And it's a terrible situation. I guess they have a chance of going in to look a little bit like the US in the 1970s, where I don't think the 70s are a good comparison to what we're experiencing in the US today. On China to me is, if I want to invest in a country, right, I can pick any country in the world. A couple of things I like to see is, I want to see, number one, I don't want a lot of government intervention, right, where, the state can put laws that, punish me. Brazil would be a great example, right? When you privatize or publicize whatever they did with Petrobras, that is all of a sudden changing the rules of the game. So China has strong government intervention. As a shareholder, I want to have lots of transparency. China's market for years has been, criticized for not having that kind of transparency, and that hasn't improved markedly. And the third thing is, I want to invest in a country where the shareholder is actually not riding in the back of the bus, right? The shareholder is viewed as somebody helpful to the market. And in China, unfortunately, I think shareholders are the back of the bus, a little bit like Russia. So to me, I'm not a big China fan. In fact, our view is China may have peaked already. I think, not only do they have those sort of structural problems in their market, I look at things like, I'm not sure there's any companies that still single source from China anymore. How could you? Right? You already had the issues of, intellectual property theft and, the joint venture problems they had. But then you had trade tariffs, right? Which is not just a Trump thing, it's a Biden thing too. So, that doesn't help. And then all of a sudden I have COVID and zero COVID tolerance there. So supply chains get shut down. So why would I single source out of China? So I think there's a lot of things going against China. That's not even mentioning the property issues that are going on there and all that. So we own emerging markets ex-China. That's one of the things, we're underweight emerging markets. And then when we have emerging markets exposure, we're trying to steer away from China, which is tough, because I think China's and Taiwan together are probably 40% of the emerging market index.
David, do you want to ask a question, or should we go to Lily Boyd first?
Yeah, I do have, so one question for you, and I agree with you talking about wages and how we're not in the kind of 1970s cycle for a number of reasons. We don't have women entering the workforce, we don't have the immigration. But my current like viewpoint, or our TROSA's viewpoint, is like it's almost split, because I do think there's going to be continued shortage for like blue collar kind of service type jobs, and I could very much see wages continuing to grow in that level. Whereas for more traditional jobs, I think we're going to export it with the strength of dollar to other developed markets, because it just makes too much sense for there to be real wage growth there. And so I think that has a direct effect on certain industries, companies that have big real estate footings, that have tight margins, heavy costs on the service side. I think are seeing some pain, and I don't know if that's going to go away anytime soon. One might say it's secular. So
Yeah, well, maybe it is secular. Supply chain, I mean, touching on the service sector just for a minute, maybe I'll touch on inflation too. There's some structural inflation issues. For example, reshoring to the US is going to be inflationary. More regulations is inflationary, things like that. But there's also some, things that are less structural, more event driven. Just a, example, COVID shut down supply chains, right? And I always make this analogy, and I don't know if it works for you, but I'm an analogy guy. For those of you that live in climates where your grass doesn't grow all year, you put your lawnmower in the shed in November and maybe pull out in May. And my guess is when you start that lawnmower in May, it doesn't just start right up, right? Because motors were made to be run. And the longer something's idled, right, the more difficult it is to start up, particularly if you're going to start it up under load. For example, if I took that lawnmower, finally got it started, and went to, cut foot-high grass, I'm probably going to have another problem. Well, that's what we did with our supply chain, which is one of the most complicated motors you can imagine, right? We idled it. We idled the goods supply chain for about 6 to 12 months, and we idled the services supply chain for 18 months to 24 months. So what would we have expected when we started, right? You're going to run into all sorts of bumps in the road. Now, I would say the goods supply chain is largely fixed. Why? Because it was shut down longer. It's had more time to recover, right? So if you go to the store shelves, you're going to find most of what you need. Maybe not a new car, maybe not infant formula or something like that. But for the most part, you're going to find what you need. The services channel, to get to your question, David, that's been closed for longer. In some places, Oregon, 2 years it's been closed, right? Where you haven't had bars open, stuff like that. And it's had a lot less time to recover. So yeah, there's going to be all sorts of issues there. I think time is going to be your friend. And I think some of the things we're doing on the demand side, which is tapping the brakes, which is what the Fed's doing, is going to slow the demand for workers, which is ultimately going to maybe put a little bit of power back in companies' hands. So the service channel, I think, will come around. You're probably seeing, the announcements of layoffs, hiring freezes, delays, push outs, all those sorts of things. And I think people that have been job seekers have been paid to window shop. If I go to Dan and he offers me a job, and then I go to Cynthia and she offers me a better one, and David offers me an even better one, why settle down? I'm going to keep going around the horn until I, maximize my benefits. Well, that works in reverse too. If I now go to David and say, I'll take that job, and he says, sorry, we filled it. And then Cynthia says, we froze, that one, and now I'm going to scramble. And I think you're starting to feel that a little bit. If you look at some of the sentiment surveys, you're seeing that, just a JOLT survey last week showed that the quit rates were down. But the sentiment's starting to say that businesses are feeling a little better about, about labor. Hope that wasn't a too long of an answer.
Oh, that was a very, very well thought out answer. My question to you would be, I seem to have the hardest, as I mentioned, conceptualizing earnings at these levels for next year. And so we'll see how that plays out. But I guess my question to you is, like, with that 5.9% yield on forward earnings. Like, what are you waiting for to get bullish?
Good question. We're right at those levels that we typically, so if you went defensive, you know, you start looking for what are the signals to get you back in, and you shouldn't necessarily be looking for fundamental signals because the market will move far before the fundamental signals happen. So I tend to go back to the technicals. 4,100 on the S&P 500 was a pretty big number, and we've broken through that. That would be a signal that possibly a bottom's in. Now you want to look at other things like breadth, meaning how many companies are participating in that level, and that looks good. To me, a breakout tends to be, you know, you got to look for two things: magnitude and duration. Magnitude is how far have you broken out above the level. If we went to 4101, that probably wouldn't be a breakout. But 4150, that's pretty good, right? Second thing is duration. You know, if we touched it real quickly and then went right back, that doesn't mean a lot. 7 to 10 days has always been one of those things in my head for duration. So we're 3 days into this. I would say, you know, we make all our adjustments on the margin. So when I say defensive, I may take a portfolio that's typically 50% equity, and I may go down to 40% equity or 45, right? I'm not going to zero, right? I think that's a loser's game to try to do that kind of market timing. So when do I put that extra 5 or 10% back in the market? Probably when I really feel like, you know, that 4,100 has been, you know, broken, which the signals are starting to show that.
So Doug, Lily Boy has been super patient. I saw a question, Lily, in the chat someplace, but I can't seem to find it now. Maybe you could just ask it directly.
Oh, sure. Can you hear me?
Yep.
Oh, okay. My question is for Doug. You said that you express your view in managing money through a lot of using ETFs. Do you express your view through sector rotation? You know, since, you know, there are 11 investable sectors, you know, with the S&P. And I noticed that, you know, the technology was 8 out of the past 10 years were pretty much on top. Do you think that trend will continue? And energy was the best performing sector last year. And where do you think the energy sector will end up for this year? Thank you.
Yeah, thanks, Lily. So one, we're not a secular or sector rotator, but I did get the secular word in there just so you can do. We're not sector rotation. You know, sector rotation would be, you know, just moving among those 11 sectors, overweighting some and underweighting others. There are a lot of strategies out there that are really successful at that. That's not what we do. We tend to do sort of, you know, building a portfolio from the bottoms up, which would be, you know, picking stocks and then finding the ETFs that are, you know, best express that. As far as what outperforms, if this bull market is truly, or the bear market's, the cyclical bears behind us and the secular bull resumes, you know, what that means is that I think some of the higher beta sectors, so that would be technology, that would be industrial, that would be, you know, consumer discretionary, will probably do better. Energy, to me, I think will do okay. But energy stocks tend not to like when the price of oil is going down, even when the companies are still profitable at those higher levels. So, you know, my guess is, you know, oil will settle back down to that $60 to $80 range. You know, we always seem, you know, high price, they always say in energy, high prices bring low prices, right? Because people go out there and drill more. That's when you get the technological breakthroughs like fracking, right? Where we all thought we were running out of oil, and all of a sudden we come up with new technology that, you know, we find out we got 10 times more oil than we thought we did. So I think you'll probably see oil prices come down, and energy stocks will still be profitable, but I think the market will start to move away from them.
So I know Warren Kaplan has a bunch of questions. Warren, if you want to ask a question, go ahead, but just know that Doug's not, you know, a market timer, so he's not going to liquidate a portfolio because he sees the market being, you know, overbought, oversold. He's not going to go short. Do you have a question that you want to ask? So I'm going to assume not.
Oh, I have another question.
Go for it.
Being a stock picker, what is the longest position or stock that you've ever held?
Well, we've sold stuff for, yeah, held stuff for, over 5 years. Probably for longer than that. I don't have the stat in front of me, but yeah. No, we're not buy and hold forever.
Yeah, no, I was just gonna I was reading here real quick on the chat, Warren's questions, and I think what's interesting about the whole thread here, and a lot of it Doug already addressed, is just something that goes back to Riverfront's philosophy, which is process over prediction. You guys have that on your website. So just the idea of, what's the process to, oh, there's even a hat that goes with that. So just the idea of, which is everybody's question, we know market timing doesn't work. I think you even have a funny video, Doug, you put out about with the tattoos on your arms, about the percentage of succeeding in timing. So just talk through that, like, how do you know that your process is sound for really, if signals are fuzzy and they really don't really tell us, is the bottom end, is the top in, what is a good way to really approach building a process to kind of have a sense of when is it time to go overweight, underweight, rebalance, any advice from your experience?
Yeah, sure. So number one would be developing a process that matches what you're trying to accomplish, right? So if I'm going to be judged every day, every quarter, hedge funds, for example, a long-term bias doesn't matter, right? Because I'm not going to be around if I'm wrong for 3 months straight. We don't play in that market. There are some smart people in that market. There are great strategies, but, I don't have any expertise there. Is a company going to make their earnings this quarter? I don't know. I can tell you somebody knows in the market. So unless you have some good insight, know that somebody out there probably has better insight than you do. So I think those are our losers games when you think about who you're competing against every day. In that, our typical client is somebody who is trying to solve the problems that we probably all are. How do I fund retirement? How do I fund my kids' college? How do I do those sorts of things? And here's what I have to put in. And for that, you have to have a long-term perspective. Our time horizon, typically our shortest portfolio is 3 years. Not to say you can't get out of it and give up on us and leave after 2 months, but we try to say these are 3-year portfolios, 5-year portfolios or longer. Which means that market timing, we try to do adjustments. We're trying to do this balance. So here's this interesting story. Cynthia, by the way, one of the tattoos is, if I look out 3 months, basically 64% of the time the market is higher, right? From any given start date, 64% of the time. So I got to know those odds ahead of time. Like, I better think twice before I bet against it, because the odds are, certainly in my favor. So that would be, kind of the first thing is knowing the odds. Shoot, I lost my train of thought of what I was going to say.
Can't help you with that one, my friend.
Yeah, to get older, I forget these things.
We're talking about market timing, and then
6 months out.
Yeah. Well, it's trying to match that. It's trying to make sure that whatever. Oh, I know what it was.
Rule number 1: before implementing the process, remember what it is.
Yeah. If doing this now 30 years, and history goes back 200 years, one thing I know is, there's never been a 15-year period where you would have lost money. Never been, right? But if I go back over 200 years, what I know is there's only 2 ways you can lose money in stocks, right? Number one is you buy something that's undiversified and it goes bust and it doesn't come back, right? Enron, WorldCom, is companies go bust every day, right? So that's number one. So be diversified. That's important. Number 2 is somewhere along the way, I get scared out of my portfolio and then it bounces back and I'm not part of it, right? Maybe I didn't like Joe Biden, President Joe Biden. Maybe I didn't like President Donald Trump. Maybe I didn't like Obama, whatever it is. Maybe I didn't believe in what the Fed was doing when they were printing money. Million reasons why people leave the market and don't come back, right? That's the second way you lose money. So the thing I'm trying to, that we try to battle every day, which is hard, is that if I know every equity loss, as long as I'm diversified, is temporary, right? If you didn't know, by the way, the S&P made 70 new highs last year. So 70 times you were reminded that nobody should have lost money in the market. If I know losses are temporary, then if I run to cash, the thing I know about cash is, number one, the penalty on cash is high, right? Inflation is 9.1%. But the other thing about cash that people don't think about is once you lose purchasing power, it's gone for good, finito, right? So like I graduated from college in 1992 and McDonald's cheeseburgers were 39 cents and hamburgers were 29 cents. We ain't ever going back to those prices, right? So I got to be careful. I got to have enough sleep at night assets in the portfolio, like cash, to make sure people don't give up on their long-term investment plan and commit problem number two, which is, lose money that way. But I don't want to have so much cash in my portfolio that I end up trading temporary losses for permanent losses. And that's the balance. And on a day like today, I feel like or a day like yesterday, I felt like we had too much cash. And a day like, a couple of days ago, I felt like we didn't have enough. And you just try to have, and that's just, knowing what people's objectives are, trying to navigate through where you give them a ride that's not too crazy, that they can stick with it and they understand what's going on. And you keep a portfolio that'll get to their objectives. It ain't easy.
Yeah, I also commend you for your LinkedIn profile where you brought your daughter in and you educated her on how to invest openly, right? I commend you because my kids would run away, even though they want the portfolio. So how did you encourage your daughter to be involved and curious? And how do you keep the dialogue going?
It's good. I mean, teaching your kids, about this stuff early is super important. And one is she's, the right personality, right? So she's a ham. She likes that stuff, and her and I have a good relationship. But markets are interesting and they're fun, and I think we've turned off some people recently with some of this losses. A lot of people played the markets. It was fun when meme stocks were going up or whatever else was going up, and now people say I'll never do that again, right? We want to make sure that people understand there's real portfolio building, and then there's the fun Las Vegas casino I can play with a little bit of my fun money. There's nothing wrong with that. But that's not really investing, and teaching them that lesson early. So, I have 4 kids. They've all lost, they've all enjoyed investing, but they all lost money on, a bunch of that, fad stuff, cannabis stocks or, electric vehicle stuff or whatever. But in the end, they knew that was sort of fun money. And there's real money that you got to think about. That's going to be what you rely on to meet your goals.
Yeah, I have 2 teenagers, college age, and it's funny because I actually think the lesson of losing money can be more valuable than the lesson of winning. Like my oldest, her first portfolio was all the tech stocks, and the question is why? Well, these are companies I love. Okay, great. And those right before what happened this year. So pretty much the conversation now is, Mom, I lost all my money. And it is, well, there's a difference. Sometimes investing isn't about the companies you like, it's about the companies you need. And I think it's a lesson that you only sometimes learn the hard way. So it's kind of a fascinating conversation.
Yeah. No, it's good to learn it with $500 than 500,000.
Yeah.
Yeah. So Warren Kaplan came back and he asked, a really good question. So, and I'm going to paraphrase the question a bit because I know Warren. We've got inflation issues. Why not focus simply, use as the example on aristocratic stocks, right? You can use an ETF, or you know which ones are those companies, and do covered call strategies against them. You know, if you believe that, well, the market's not going to run away, but at least you clip some coupon and get good dividends and high quality names.
Yeah, there's nothing wrong with that. Particularly now, Cynthia, Dan, and David and I were talking before the call about a term that we use, which is called PADI. And it means pay attention to the yield. And what it means is when your crystal ball is particularly hazy, like it is now, sometimes you feel like you can see, directions of markets, and sometimes you can't. Today's, it's really hard to see it. When you can't see the direction, I think most investors are unwilling to pay for earnings that come 10 years in the future, right? So, electric vehicles are great, but if that company's not going to earn anything for 10 years, now I'm not really excited about paying up for the earnings that are going to come 10 years later. I want to pay up for earnings I can see right now. And that's going to fit I'm assuming you're talking about dividend aristocrat stocks, which are companies that pay you today. And there's nothing wrong with that. Pay attention to the yield, to me, means more than just dividend yield. It's shareholder yield, which includes stock buybacks. It's free cash flow yield. One of the things, to just be careful with any dividend strategy is, I want to own companies that can grow their dividends. If I look at any study, it's going to tell me that the dividend growers are the dividend stocks that do particularly well. If you have a static dividend or you cut your dividend, those companies really just act more like bonds. So number one is I want those kind of names. Number two is I want to make sure that they have good balance sheets. So somebody that's up to their eyeballs in debt, while they've increased dividends in the past, they're not going to increase them in the future, right? So in the end, I own a bond, and I can probably get better returns in the bond market than I can in the, owning a stock whose dividend never moves. I also like, and I'm trying to remember the aristocrat way they do it, but some of the, the Dow Jones dividend and some of them have limitations, is they won't add a company to their universe unless it's paid consecutive dividend growth for a certain number of years. And, if the longer that time period is, for example, one of them used to be 25 years. So a company like Apple or Microsoft, while they're great dividend growers, isn't going to appear in the index for a long time. Sometimes the greatest dividend growth comes from companies that initially initiated dividend, because when you initiate a dividend, you initiate at a level that you can grow it consistently for a long period of time. So I would rather own some of the names that are new dividend payers. So they got to grow their dividends. We're okay with having a broader universe of names, and they have to have good quality balance sheets. Those are kind of three things to look for. I like to kind of have a S&P sector balance too. So I don't want to own a dividend index that's 42% utilities, right? That gets me exactly what I don't want. Might as well be in the bond market, right? The technology sector, close to, 25, 30% of the S&P. I want to have that, 30% of my stocks to be tech stocks in the dividend world.
So that was helpful. So by the way, I really encourage everybody to follow Doug's LinkedIn profile and watch his conversations with his daughter. And we haven't talked specific funds that are sponsored by Riverfront, but you guys can all review them at your leisure. Cynthia, should we wrap up at this point?
Yeah, we promised Doug he would be done in 45 minutes. We don't want to overstay our welcome, so we will wrap it up. Thank you, Doug, so much for joining us. That was a phenomenal conversation. Special shout out to everyone who turned your cameras on today. It's so fun to see everybody's faces. It makes the whole show so much more fun, at least for us. We get to feel more happy hour-ish. And thanks for joining as always. And everybody go out and have a secular good time tonight. And we'll see you next week.
Thank you.
Thanks so much.
Thank you.
Thanks. Bye. Bye.